So welcome to the April edition of the Cafe Seminar Series. Today we're very pleased that Savitar Sundaresan from Imperial will be presenting his paper entitled More Risk, More Information, How Passive Ownership Can Improve Informational Efficiency. It's joint work with Adrian from INSEAD, who's also on this video. The presentation will be followed by discussion by Liyan from the University of Toronto. So thank you again, Liyan, for accepting to give the discussion. So as usual, there will be 40 minutes for the presentation, 20 minutes for the discussion, and 15 minutes for Q&A. Savitar, the screen is all yours.
Okay, thank you very much. Thanks to Rotman, Kim, and Laurent for inviting me. Thanks to everyone for being here. Thanks especially to Liyan for agreeing to discuss the paper. This is joint work with Adrian at INSEAD, and it kind of started based on some kind of mutual interest we have on institutional investors and price efficiency more generally. But we took note of a couple of kind of interesting facts, which I think would provide a good motivation for this topic. So the first is to point out that passive investors are major shareholders in basically all publicly traded firms at this point. In the US, passive investors hold about 20%, a little bit less than 20% of outstanding shares in the S&P 500. And almost as importantly, it's not kind of, there's a lot of cross-sectional heterogeneity. So even among the stocks in the S&P 500, there's a fair amount of variation in how much is held by passive investors. It can go from about 7% at the low end to up to 30% at the high end. So there's a lot of heterogeneity there. Now, passive investors are kind of defined as being agents who don't collect kind of fundamental information about the stock. They're holding a large diversified portfolio. They're not collecting stock-specific information. And so the theoretical literature, of which Adrian and I have both been a part, has kind of uniformly predicted that an increase in passive investing should lead to a reduction in price informativeness, because there are active investors who collect information, passive investors don't, so a growth in the passive sector should lead to a reduction in the total amount of information collected. Now, empirically, the opposite seems to be true, at least in broad correlation terms. So there seems to be a positive correlation between the price informativeness of a particular stock and the degree to which that stock is held by passive investors. Now, the first point is probably unsurprising. It makes good intuitive sense. The second point is probably a little bit surprising. There may be explanations for this, but we wanted to posit that there is some causation, that actually passive investing itself is leading to a series of changes that result in higher price informativeness. Now, this might not come about directly because passive investors are somehow changing their investment strategy and imputing information into prices, but rather because firms can respond to who is investing in their stock. And so I'm going to lay out very briefly what our kind of proposed mechanism is, and then hopefully if you buy into that, then the rest of the paper is going to be all gravy. What we do is we take a very standard noisy rational expectations asset pricing model. And maybe you'll have seen models like this before. Basically, there's a noisy fundamental that's tied to a particular stock. Agents can choose to learn about this fundamental before trading, so they can collect information subject to a cost. Then they see a signal which tells them about the fundamental that allows them to form endogenous portfolio decisions. And so endogenous portfolio and endogenous information choice is kind of the standard setup in most of these models. What we do, which some other papers also do, is take into account passive investors, which we are going to model as being both price and information insensitive. So they hold for reasons not related to the informational content, and not related to informational reasons. What we do that's new, or what's kind of a methodological contribution from in this model, is that we allow for a supply side response. So basically, for every stock that's being traded, there's a firm that underlies it, and we allow the firm to make investment decisions, real investment decisions, by looking at who will be buying their stock. And if they see a high level of passive demand for their stock, that might cause them to act differently than a firm that sees a low level of passive demand for its stock. So this methodological contribution allows us to kind of uncover a novel mechanism. And specifically now we can say things not only about the informational content of prices, but also about firm real investment decisions and about a bunch of kind of asset pricing variables as well. So the mechanism is, as the paper describes it, is the following. Basically, for stocks that see a high level of passive ownership will have lower levels of sensitivity in the price to their volatility. Basically, passive investors drive the price up and are not holding it for informational reasons. And so volatility in the fundamental won't affect passive investors' decisions. And so the price as a whole is not going to be as sensitive to fluctuations in the fundamental. As a result, the firm whose stock is being traded might be encouraged to take on more risk. As a result, they kind of get a free pass at making themselves more risky. They can undertake projects that they might not necessarily have undertaken if they were to be punished in their stock price as a result. So they use this kind of lowered sensitivity to volatility as an opportunity to invest in more and riskier things. What that means is that as they choose to invest in more and riskier things, that drives up fundamental volatility, precisely the thing that passive investors are kind of protecting them against in their price. Now, this is where the kind of more traditional mechanism of the noisy rational expectation model comes in, which is that, generally speaking, the eye of an active attention is drawn to the most volatile asset. So basically, the more volatile an asset is, the higher the returns to learning about that asset. And so the higher level of fundamental volatility in a particular stock, the more active attention is going to be devoted to that stock as a result. What this gives us is that you actually get higher price informativeness for this same stock now. So even though you get a higher amount of passive ownership through this kind of anticipation on the part of the firm will make their fundamental more volatile, which in turn attracts more active attention, which in turn makes the price more informative. So this is the mechanism that we're kind of spelling out in this paper. We also get some predictions about asset pricing variables. So we see increases in prices and increases in return volatility, as well as excess returns. All of the statements I've just made are comparing two stocks in an identical kind of financial market setting where one is held proportionately more by passive investors than the other. We can also wonder what happens if you actually increase the number of passive investors or the size of the passive sector in the financial market as a whole. So aggregate shifts in kind of assets under management. What happens here is it actually magnifies or amplifies the cross-sectional effects. So you see bigger changes the more passive investors there are, but the directional change in terms of what happens will depend on who the passive investors are cannibalizing. So if they're taking over for retail investors who don't collect that much information, then our mechanism would predict that a growth in the passive sector results in a growth in price informativeness. However, if they're taking over for hedge funds or information collectors, then the reverse could be true. Although I don't discuss it in today's talk, we also have some potentially interesting results on multiplicity of equilibria and information crashes, which I will hint at when we get to later in the talk. I'm not going to spend a ton of time on the literature. Basically, there are a bunch of papers that think about institutional investing and price efficiency. Ours is adding to it in the sense that we're allowing for this kind of firm real investment decision, which is distinct from the kind of feedback literature because there's no informational content that's being exchanged here. So, but I can come back to the literature if there are questions later. Okay, so to set up the model, this is our kind of timeline. And the last three periods here are relatively standard. So this would, if you were familiar with noisy rational expectation models, this will all be pretty standard. There's a stock. The stock has a noisy fundamental, which will be revealed in the terminal period. Agents can trade the stock in time 3. So that's the penultimate period, and they can observe some signals if they chose to collect information and trade. The period before that is where agents who have the ability to collect information decide how much information they're going to collect. So subject to a cost, they can improve the precision of the signals that they get. What we do, which is kind of new in the setting, is we add this first period, this time 1. So this is what we call the real investment period. And over here, firms are going to allocate capital to growth opportunities. And so based on the capital that's allocated here, that will give them that will determine the mean and the variance of the fundamental that is to be revealed at the end of the period, or sorry, at the end of the time. So the last 3 periods are completely standard. The departure is going to come from this kind of first bit. We have big N plus 1 many assets. So there's a bond. The bond is in infinite supply. It has an exogenously specified gross return RF. It's also our numerator, so the price is normalized to 1. And then we have big N many stocks. So each of these is a risky asset. The asset has a random payoff, XN, and it pays off. The payoff is realized at the end of the game when agents receive their profits and loss and consume. And it's in finite supply with prices endogenously determined in the portfolio choice period. We have a unit continuum of traders, which we're dividing into 3 subsections. So each trader is atomistic, but they're one of 3 types. The first type is a passive investor. So these investors we model as being price and information insensitive. So that means that we're taking their demand as being kind of exogenously specified for the moment. I'll talk at the end about something we're working on right now, which is to try to relax this and specify endogenized passive demand as well. Then we have active traders, which we're splitting into 2 groups. We have informed active traders. So informed active traders are the agents who can make information decisions in time 2. They collect information by improving the precision of a signal that they will see in time 3. And they make endogenous information choices, endogenous portfolio choices. They can also learn from the price. The remaining fraction are uninformed. You can think of these as retail traders, perhaps. They're also active in the sense that they make active trading decisions, and they can also learn from the price. So their portfolio choices is an endogenous problem. But we're calling them active as well because they are able to learn from prices. And so the only distinction between informed traders and uninformed traders is this ability to collect information in the second period. Everybody has Cara preferences with a common risk aversion row. We're going to specify demand for a stock. So theta will refer to the demand by agent I of type J for stock N. So I is the index for the agent. J can be P or I or U, depending if they're passive or informed or uninformed. And there are N many stocks. So that's what the N refers to. There's going to be a noisy demand, which is kind of independently distributed across assets. And big gamma is going to be distinct from this theta in that big gamma corresponds to kind of the fraction of each type of agent in the market. So we're going to think of that as kind of assets under management. And we're going to think of theta as the shares owned by a particular type in a particular stock. So this is the kind of back end that we've added onto the model, the firm. So each stock is associated with a firm, and firms have access to a risky project. And so they have these opportunities that they can invest in with diminishing returns to scale. So they can pick their IN, that's their investment, subject to a quadratic cost, and a productivity AN, which is a random variable with mean mu A and volatility sigma A. And this functional form comes from Subramanian and Titman, but it's a convenient one for our purposes. Quadratic makes it one of the relatively easy to take derivatives. And so how do they fund this investment? Well, they're going to fund the investment by issuing equity. So they issue delta units of equity in order to make an investment of scale I, which then will determine what the noisy payoff is going to be. That determines what X is. And firms choose this I to maximize future expected stock price. And the mean and the variance of these cash flows are going to be increasing in investment. This is kind of our one of the keys to our result, which is that as a firm chooses to invest more and more, that drives up the fundamental, but it also increases the volatility of the fundamental, which is what's going to have an impact on learning decisions. And importantly here, we're abstracting from feedback effects, so firms don't learn from prices. Right? They just, all they care about is the kind of expected value, and they're taking the priors as given. So finally, all agents have common priors about Xn and Zn. active investors can choose to collect information in the form of improving the precision of their signal about a particular asset, and the signal is Y. That's going to be the signal for investor I about stock N. And so each agent is going to choose this at a strictly convex cost kappa. The choice of kappa is actually going to be somewhat important. This is what goes back to our the multiplicity thing I hinted at earlier. We choose a quadratic cost, but I'll tell you what happens if you were to choose other types of cost functions. Okay, so that's everything for the setup. What I'm going to do in the results is I'm going to try to show you an equilibrium condition, the mathematical expression for it, and talk you through it, and then I'll show you a graph or some graphs for each to try to build some intuition. So the first equation is going to be for the firm. So this is the kind of first order condition for the firm. The left-hand side is the net marginal benefit of investing, and the right-hand side is the marginal cost of investing. So just to go through the terms, mu A, this is the mean of the productivity term, minus Cn, this is the cost of investing, over the risk-free rate, this is the excess amount. So this is the that's why I refer to it as a net marginal benefit. On the right-hand side, this is going to be decomposed into two terms. This first term is kind of the derivative of the expected stock price with respect to the posterior variance of informed traders. So basically, how much is the firm going to be punished for having a volatile fundamental? So how sensitive is it to the beliefs of informed traders? The second bit is the sensitivity of the variance itself to the investment. So if the investment becomes more volatile, what does that do to the posterior of my informed traders? So mathematically, that's what it says. Basically, intuitively, what this says is that more investment is going to lead to a higher payoff. That's the left-hand side. More investment also leads to a higher variance, which is going to be reflected in a lower precision of beliefs on the part of agents if you hold their learning constant. And it's also going to result in a higher risk premium. So you're going to get that's the cost part. Visually, perhaps this will be a little bit clearer. This is the first plot. The x-axis here is the amount of investment, so that's IN. And the plots are marginal benefit and marginal cost. So marginal benefit, we assumed a kind of quadratic cost, a quadratic investment thing. It was A times I minus CI squared over 2. So you get a downward sloping straight line for marginal benefits. Marginal cost, you get this kind of non-monotonic red shape. And so the idea here is that this is the part that comes from the two partial derivatives on the previous slide. So this is the degree to which informed traders are going to penalize the firm for having a more volatile fundamental. Now, the reason this is non-monotonic is because of the convexity we've chosen for our cost function kappa. So it turns out that quadratic, which is what we chose, is not convex enough for sufficiently high levels of investment. When you get really, really high levels of investment, say out here, then it turns out that the agent will overcome the cost of collecting information because the fundamental becomes so volatile that it actually behooves them to pay that very high cost and acquire really precise signals. So you get this kind of bend in the river over this hump, and you get kind of reductions in the marginal cost for very high levels of investment. If we were to choose a more convex cost function like a cubic or some higher order polynomial, then this would again become monotonic. And we discussed this in the paper, but for the purposes of this, we're focusing on the single equilibria case. So what happens, the reason there are two red lines, is one of them corresponds to a case for a low level of passive holdings. That's the kind of more spaced out dashed line. And the other one corresponds to a higher levels of, or a higher intensity of passive holdings. So moving theta from 0.75 to 1.25. And what this does is that the higher level of passive holdings reduces the degree to which active investors can punish the firm for having a more volatile fundamental. And so it reduces the marginal cost of investing. So an increase in passive holdings shifts down the marginal cost curve from line 1 to line 2. And as a result, the total amount of investment will increase. And so this is kind of the first step in our chain. You can see this as well in the latter two graphs. So on the x-axis here is the assets under management of the passive firm times the demand of that of passive investors for stock N. So you can think of all of this as the total amount of passive holdings of stock N. And I think, and so for these graphs, gamma is being held fixed and we're varying theta p. So we're saying gamma is fixed at 0.2, I believe, and theta p is varying around 1. So it goes from about 0.14 to 0.26. And you can see that as passive ownership increases, investment from the firm will also increase. And not surprisingly, as passive ownership increases, the cash flow variance will also increase because the investment in the risky growth opportunities increases cash flow variance. Okay, so this is kind of what's happening on the firm side. The next equilibrium condition I want to look at is the investors, the active traders' information decision. So that's marked here. This is the marginal cost of increasing the precision of the signal for an informed trader. And this is the marginal benefit, which has a bunch of different terms. But just to fix ideas, this first bit is the the precision of the fundamental. So this is what's determined by the investment decision of the firm. This is the precision of the signal that can be extracted from the price. We're also going to call this price informativeness. And this is QN. This is the precision of the all the informed traders. So there's a -1 up here. So this is all inverted. Basically, what this means is that a higher degree of precision in the fundamental is going to lead to a lower level of precision in the signal. Basically, investors want to look at volatile things because those are the most profitable things to learn about. If the precision of the fundamental is very, very high, then there's not much benefit to learning about that. If the precision of the signal you can extract from the price is very high, again, this means that information collection will be low because public information and private information are strategically substitutable. And again, private information is strategically substitutable with itself. So if everybody else is paying a lot of attention to a particular stock, you don't want to pay attention to it as much. Now, over here, again, remember we assumed that kappa was a quadratic function, so the marginal cost now is going to be a straight line. On the x-axis here, we have the precision of the private signal. On the y-axis, again, we have cost and benefits. Marginal cost is going to be a straight line. Marginal benefit is going to be decreasing, right? This is the strategic substitutability I was talking about. But now we've plotted two different lines for two different values of sigma n. So this is, remember that when we have a higher degree of passive ownership, we have differential levels, when we have differential levels of passive ownership, we have differential levels of investment by the firm, which then lead to differential levels of fundamental volatility. So fundamental volatility are the thing we're varying here. And we see that when you have a low level of fundamental volatility, the marginal benefit for learning about that particular stock is pretty low. When that fundamental volatility increases, in this case doubles, then the marginal benefit also increases. And so active investors, active informed investors, will pay more attention to a particular stock that has a noisier fundamental. And so this was kind of just showing you the individual decision. Over here on the right-hand side, we have passive ownership again on the x-axis. And on the y-axis, we have price informativeness, which, as I mentioned, we've defined as the quality of the signal you can extract from the price. And so here you have an increasing relationship precisely because of this coupled with the firm decision. So this is the kind of, that's the heart of the main result of our first main result, right? Which is that an increase in passive ownership leads to an increase in price informativeness. The fact that this is a positively sloped line should be hopefully ex ante counterintuitive. And now with this kind of new mechanism, hopefully makes some sense. We can also talk about other asset pricing moments. So over here, I've written out the expression for the expected stock price. And so there are several components here. SN, so this is what we call the expected stock price. There's the expected cash flow. So this is the kind of mean of X. There's also the fact that this was funded with equity issuance, right? So there was a delta issuance of stock in order to fund the investment. And so as a result, the size of the investment will negatively impact the stock price due to this kind of issuance of stock. So there's a negative term here. I'm calling it dilution. Then the last part is this risk discount. And so this part is the amount of a discount that's commanded by informed investors who don't want to hold a stock with a high level of volatility. So it turns out if you were to increase theta p, so again, this is the cross, if you were to look at two stocks, one of which has a low level of passive holdings and one of which has a high level of passive holdings, the one with a passive level, with a high level of passive holdings will see a higher price, but it turns out it's for three separate reasons, each of which can be kind of disentangled a bit using this equation. So the first one is kind of the mechanical one, which doesn't depend on our mechanism at all, which is just to say that if you replace active demand with passive demand, there are fewer active investors, which means that they can command less of a risk premium in order to hold this stock. And so the price goes up, kind of mechanically. The second part, which is now where our mechanism begins, says that if there's a higher level of passive demand, then that's going to lead to a higher level of investment by the firm, which in turn is going to lead to a higher mean of the fundamental. So this term is going to go up. And so that leads to a higher price. The third bit, which again is a result of our model, which is that now when there's a higher level of the mean, there's also a higher level of volatility, but this is actually going to encourage active investors to collect more information about the stock, which actually reduces the risk premium that they're going to demand. So then you get that this term is actually going to reduce. It reduces for two reasons. This part reduces mechanically because of the growth in passive demand. This part decreases endogenously because of the additional attention paid to the now noisier fundamental. So you get three effects, each of which kind of compounds the other, and all three drive the price up. So you can see that visually here. On the x-axis of all four is passive ownership. And so you have passive ownership again. We're keeping gamma p fixed and we're varying theta p. And the first plot on the top left is talking about the expected stock price. So here the dashed gray line, I don't know how clear it is, but it's basically, it looks roughly like the 45-degree line. This is the impact of just the mechanical replacing active demand with passive demand. So that drives the price up just because there are fewer shares held by active investors. From the gray dashed line to the pink dashed line, that's the bit that comes from the firm now investing in a riskier project, which drives the price up. From the pink dashed line to the red solid line, that comes from active investors, informed investors, being able to adjust their learning decisions, which then in turn feeds back to a lower discount and therefore a higher price. So all three effects compound each other here. You can see the impact on other stock market variables here. So stock return variance, this is going to be increased at first quite a bit just by the firm's decision to invest, right? So the firm's decision to invest in a risky project drives up the amount, the size of the fundamental, and therefore the mean and the variance. Now this mean is kind of attenuated somewhat, this variance is attenuated somewhat by the fact that more attention is being paid to this particular stock by active investors, so the return variability will be slightly lower. If you look at expected excess return, this actually our mechanism flips the sign. So in the first case, if it was just the mechanical effect, then a growth in passive demand, which crowds out active demand, would drive up the price, but do nothing to the fundamental, which means that excess return would be decreasing. On the other hand, if the firm is now allowed to react to this growth in passive demand, the firm will invest more in risky projects, which then actually increases the fundamental, increasing expected excess returns as well. And then if you add on top of that, the fact that informed investors are able to collect more information about that as well, the return can decrease slightly because of that, because they're compensated via their information. The Sharpe ratio is downward sloping, and it's fixed somewhat by our mechanism. It's not quite as drastically downward decreasing with our mechanism as it is without, but it doesn't overcome the increase in variance is not overcome by the increase in excess returns. We also look at trading profits. So trading profits we can only really look at it for uninformed and informed investors because we're treating passive demand as being exogenous in this specification for now. Passive demand is not, it's not going to, we don't have a problem there to analyze profits with. So trading profits are going to be increasing in passive ownership for both uninformed and informed active traders. For the uninformed traders, it comes from the higher excess returns that are being generated by this firm decision. Whereas for the informed traders, the increase is coming not only from that, but also from this additional attention that they're paying to the noisier fundamental. So you see that there's an argument here that the inclusion or an increase in passive ownership can actually separate the two groups more. Now, if we want to think about, so far, all of the results I've been talking to you about have been holding gamma P, gamma U, and gamma I fixed. So the number of informed, uninformed, and passive agents in the market have been the same. All we've been looking at are changes in how much or how intensively each passive investor has demanded different stocks. And so we've been looking at different different stocks with different levels of demand for the same level of assets under management. So what happens if we adjust, if we now start thinking on the kind of, I guess this would be the extensive margin. So if we change gamma P, so we allow more investors to become passive, what would happen to our results? Well, actually, the answer is it depends, because it depends who's losing out. So if you have an additional gamma P, it has to come either from an active sector or from the, either from the informed sector or from the uninformed sector. I should say I, apologies. The cross-sectional variance, the cross-sectional variation that you would expect to see is similar. So it's still the case that the directional impact of changing theta P for a given cross-section of gamma P, I, and U will be the same. But the direction, the sign change can switch. So over here, I have, this is, the x-axis is gamma P now, as opposed to gamma P times theta P. So this is the total number or the fraction of investors who are passive. And on the left-hand plot, this is holding the number of informed traders fixed. And on the right-hand plot, it's holding the number of uninformed traders fixed. So in this case, we're growing the passive sector at the expense of the retail sector. And in this case, we're growing the passive sector at the expense of hedge funds or the informed sector. So you can see that the relative placement of high levels of theta and low levels of theta, that is the black dashed and the blue dashed line, are the same. It's still the case that increasing intensive levels of demand for a particular stock will increase price informativeness. So if I go vertically across this, right? And that's true on both the left-hand and the right-hand plot. What switches now is the power of that, depending on who's left to collect information. If you cannibalize the retail sector, well, the retail sector wasn't able to collect information at all, and so the total amount of information collecting agents is the same. And so their presence can be felt quite strongly. If, on the other hand, you're growing the passive sector at the expense of the information collectors, then no matter how much more attention they're paying to more volatile fundamentals, there just aren't enough of them to overcome this effect. And so you get that price informativeness will decline no matter what the theta is. On the left-hand side, if you're only cannibalizing retail, then price informativeness can increase, and potentially in the aggregate, it can increase as well. But if you're cannibalizing informed traders, then it cannot. So the sign of the impact of the aggregate growth in the passive sector will depend on who is being forced out. You can see this also in expected stock prices. Again, the effect here is not as drastic as it was for price informativeness. Price informativeness was quite stark, that it went from slightly positive to very negative. Here it goes from slightly positive to slightly negative. Again, on the left-hand side, we're increasing passive demand at the expense of uninformed demand, while on the right-hand side, we're increasing passive demand at the expense of informed demand. So the difference between the two is just that here you get this increase in the price, which comes on a stronger effect from the firm side. So basically, when you're when you grow the passive sector at the expense of the uninformed agents, you get the same firm side effect, but you also get that this effect from the informed traders, who are now able to collect more information and command a lower discount as a result. And so you get the price moves in the way that you would expect, whereas the reverse happens here because there just aren't as many informed traders. Okay, so that was the last result I wanted to show you. There are a few extensions that we do in the paper where we talk about different settings. So we think about this in the context of benchmarking instead of passive investing. And we look at the multiplicity of equilibria, stuff that I mentioned briefly at the outset. But I'm going to conclude here. So, which is that our contribution has been to include a supply side investment decision to an otherwise standard noisy rational expectations model. And this has allowed us to do a few things. So in the cross section, it's allowed us to think about how the makeup of your investor base is going to impact your firm investment decision. So we find that higher levels of passive ownership incentivize firms to increase their investment and their risk. That kind of carries back into the informed decision of the information decision of informed traders. So higher levels of risk now attract increased amount of attention from informed investors. And as a result, we get this kind of potentially counterintuitive increase in price informedness. So this provides kind of a novel channel through which passive investing can increase price informedness. In the aggregate, it depends on who's losing share. It could be the case that an increase in the passive sector could lead to an increase in price informedness, but it depends on who's losing out. The next step that we're working on currently is to endogenize passive demand. So we're looking at allowing passive investors to form endogenous portfolio decisions based on kind of a diverse portfolio of assets instead of taking the demand as exogenous. But that remains work in progress. Thank you very much for your patience, and I look forward to Liyan's discussion. Thanks.
Thank you, Savitar, for very clear discussion, very clear presentation. So the discussant is Liyan.
Thank you very much for inviting me to discuss this interesting and great paper. So there might be some background noise. I apologize. My kids are taking online courses now. So this is really a great paper and studying a very fundamental question. And I know Savi and Andy very well. I know they are great presenters. So normally I think the discussion serves two purposes. The first one is probably try to convey the idea better to the audience. Since I think Savi is a great presenter, I don't think I can improve much on that part. And number two, try to offer some comments to think about the interpretation and push the knowledge frontier. Hopefully maybe some referees also ask a similar question, since I'm a person working in this area. So maybe people have similar thoughts. So I'm going to focus on the second part basically. So I know that 20 minutes, I'm going to spend 5 minutes on the first part, try to summarize the results, the setup, and devote the majority of my time to the second part. So as I started, this paper asking a very fundamental question. Think about we know now passive investing is very, very kind of prevalent and is increasing. And what's the impact of this passive investing on financial markets and the real side, the corporate finance? The paper is very kind of very elegant, the model. I think the model basically you think about it as a 4-period model. The period 2 to period 4, these are the standard information models. So in data 2, people will acquire information. Data 3, people will trade. And the data 4, people will consume. And normally in the literature, the active period are data 2 and the data 3. So what the paper does is to add additional period, which is the data 1 before data 2, think about the real side. So that's the model part. And this also differs from the traditional feedback models. The feedback models think about how real side comes from learning from price. So normally the feedback model will add a period here in the middle of data 3 and the data 4. So which is here. So after the price is formed, the managers will see the price and extract information from the price and adjust the real investment. So that's the major difference from the previous model to the existing kind of feedback models, which are the workhouse model try to combine financial market and corporate decisions. So I think this is an elegant because the model only needs the data part, also simplify the analysis a lot. So this is the model part, and the main mechanism is there's a lot of steps, but the logic is very tight. So let me explain a little bit of the logic. So if you have a passive investing, which is modeled as an increase either in the average share of some exotic investors or the increase in the population size of this investor, those passive investors, that will drive up the demand for the asset. As a result, the cost of capital will go down because you have a larger demand. So the average price will go up, the cost of capital will go down. So that will encourage real investment. The real investment will scale up the size of the firm. So this will affect the first order moment, which is the mean. Also, more importantly, the second order moment, which is the variance. So the cash flow volatility will increase. And in the model, when you increase the cash flow volatility, information acquisition by active players will increase. And as you increase information, that will drive up price informativeness. So this is a channel, basically from passive investment to lower cost of capital, to cash flow volatility, to information acquisition. So each step is very, very logical, and but the result ex post very intuitive, but ex ante you derive some results that's very counterintuitive, but also highly empirically relevant. And what the paper does, so deriving this mechanism, after that, the paper does two types of comparative statistical analysis. And I said that two parameters in the model they try to analyze. One parameter is the average share of those passive investors. And they fix the number of passive investor population, the size of passive investor population, and think about the average shares of those people. And that will give you cross-sectional implications. The second analysis, it fixes the kind of the average share size of passive investor, but increase the size of the population of passive investors. That will give you aggregate market implications. You don't compare stock A versus stock B, and you think about the aggregate in the trend. So that's two major analysis. And then the paper also extended to benchmark investing. That's partially endogenized passive investing. And after that, the paper derived a lot of empirically relevant implications. So that's the overall summary of the paper. I think this paper, a lot of things I like. I think the paper asked a great question, and the result, as I said, kind of ex ante surprising. The ex post is very, very intuitive. It's very kind of plausible. And the model is very elegant. I particularly like the tight connection between the model part and the empirical. So if you think about what's passive investing, what's active investing, so there are multiple ways of modeling those different parts. So I think the paper does a great job of capturing that. So that's my kind of 5 or 4 minutes summary of the paper. And then I'm going to think about my comments. Savi and Adrian are very, very careful researchers. So they actually, when I try to read the paper, think about some comments and how to interpret the model. So very often they already thought about that. So they thought about my question. They either put a footnote or write some kind of discussions about those kind of questions, and partially address my concern. Probably not a constraint, my curiosity. So I think, but still, if you want to understand the model or interpret the results, it's still useful to think deeper to how to kind of understand the robustness of the result. Maybe I try to think about how to improve the paper. Maybe you want to rewrite a little bit, restructure a little bit of the model part. So I have two sets of comments. The first one is my major comment is about the mechanism. I actually did thought about this. I also put a footnote there. And then I have some other comments, and then among the other comments, number 2 is my major kind of comment. So let's think about the first comment. The first comment is if you increase high cash flow volatility, so you will increase the information acquisition. This is a very, very natural from on the one hand, but also I think this result is not robust depending on the context, depending on the situation. So let me explain that. I try to put this interpretation in a very simple perspective, which is a kind of partial equilibrium perspective. You think about one person, a decision maker, try to learn something. The target is X, which is the cash flow in the model. I'm sorry, Cynthia. Okay, sorry. I'm going to talk to my kids, try to make them quieter. So the cash flow, the target is X. So it's normal distribution with mean zero sum variance. The preceding is tau X. So in the paper, the paper uses this variance is sigma. So I use the tau to denote the preceding. So this is slightly kind of change our notation. Tau is the preceding. So 1 over tau is the variance. So if and then you also have a signal. It's a similar notation. A signal is the cash flow plus some noise. The noise has a preceding tau epsilon. So this cash flow and the noise are kind of mutually independent. So this is very traditional. And then you think about how to acquire information. You try to endogenize this tau epsilon. Of course, that's kind of a benefit cost analysis. You have a benefit function. You have a cost function. Econ 101 tells us the marginal cost is equal to the marginal benefit is equal to marginal cost. That will determine the optimal information acquisition. And the question in the paper basically asks if you increase the variance of X or lower this tau X, how will that affect the optimal information acquisition tau epsilon star? So the paper focuses on the channel of marginal benefit, this part. So if that's the focus. If you increase the variance of X, the lower tau X, that will be through the increase of marginal benefit, that will increase the information acquisition. So that's the focus of the paper. But I think this result is very sensitive to information technology. Actually, Savi and Adrian already thought about that. They put a footnote of 9 and write their thought and very carefully. And also they cite this IFS paper to provide empirical evidence supporting that. I know this paper very well because Thierry came to Rotman in 2019 presenting the paper. I read a similar issue to Thierry. We discussed a little bit about this question back then. So let me first explain what's driving the current channel in the paper, what's driving the result in the current paper. So in the exponential utility function setting, so the benefit function is proportional to your variance. So the posterior preceding. Intuitively, so when you have better information, you will make a more informed decision. So that's why it's proportional to your posterior precision. And so you can basically interpret the benefit as the log of this posterior precision. So why it's a log? Because you have exponential utility, you try to convert the utility into money. So the certainty equivalent, it will give you a log. That's a concave function. And then you fix the marginal cost function. You look at the marginal benefit function. The marginal benefit function is given by this ratio. It's very, very simple. If you lower tau X, so meaning you increase the variance of our cash flow X, cash flow volatility. So the marginal benefit function will increase. So you graphically, that will increase from this red to this green. As a result, the optimal kind of choice information acquisition precision will increase because you fix the marginal cost, you move up the marginal benefit. So what's the intuition here? So intuitively, basically, if you have higher uncertainty, that will give you more scope to learn. That will increase your marginal benefit. So you can think about the extreme case. Suppose X initially had some volatility, but now X volatility becomes 0. Everyone knows X is a constant number, so there's no point to learn. So that's a common knowledge. So that will lower your marginal benefit. Basically, if you increase the volatility, that will increase your learning scope. It's expand the learning scope. That will move up the marginal benefit. As a result, increase the kind of the information acquisition outcome. So that is the main mechanism of the paper. I think that's intuitive, that's natural, that's plausible. But again, as I said, this result in the literature depends on a lot on the situation. Now you think about the alternative. You are not changing the marginal benefit. It's possible you change the marginal cost. Suppose that let's forget the marginal benefit part, but we forget this part. Let's think about the marginal cost. So how can that result must also change to a different direction? So this is the rational attention literature, basically. It's an entropy-based cost function. Let me explain a little bit. So in the rational attention literature, so the cost depends on your mutual information. Your target is X, your signal is Y. So the mutual information is given by this kind of the log of this variance ratio, the X ante variance over the X post variance. So that's a mutual information. The mutual information is smaller than your capacity, your attention capacity. So this capacity I can be increased according to some cost function. For example, maybe you go to take some courses, hire more people, you can develop some software. That will increase your capacity. So you think about initially you don't know how to do calculus. So after you attend some mathematical class, you know how to do calculus. That will give you some kind of extra capacity, but this cost function K is increasing and also convex. And by the constraint now, the cost function will be given by this mutual information smaller than this I, because you only have one target. It's equal to this alpha bar, and you can expand that according to this cost function K, and you can think about this, relabel this T and loss, this compounding function as C hat. So that will be your cost function. Now you take the first order derivative, you will see that if you lower tau X, you will increase this part, you also will increase this part. So that basically will move up your marginal cost. So now if you lower tau X or increase your variance of X volatility, so fix the marginal benefit, you will increase your marginal cost function. As a result, information acquisition outcome will decrease. So now what's the intuition here? The intuition basically comes from familiarity. So since we are researchers, you can think about doing research. I think that's a very good context. Taking myself as an example, I only working in the areas of financial markets and behavioral finance. And now suppose that a pandemic situation comes out. Now pandemic is uncertainty. So there's a lot of uncertainty, the good research opportunities. So that's giving me some incentive to explore that area, to write a paper. So indeed, I write a paper to make myself happier. So that's the channel emphasized by Savi and Andrew. But on the other hand, this area is new, completely new to everyone, basically in the finance literature. It's difficult for us to position the paper. So if you are working in some area very, very new with a lot of uncertainty, so your cost of positioning your paper is higher. So it's you have to think about, okay, what will be the contribution to the literature? I have to think about some other kind of non-finance literature, explore other things. So that you're not familiar with the literature. It's difficult for you to position. It's easier for me to write a paper in financial markets and behavioral finance because I know the literature well. Once I know some results, it's easier for me to judge whether this will make a contribution to the literature, whether it's significant enough. So I think that's the kind of marginal cost. If you are familiar with that, if you don't have a lot of uncertainty, it's easier for you to digest the content. So that's the intuition for this marginal cost part. So basically, this is not about the paper per se. It's about the entire literature. Basically, in this literature, so the results are very, very sensitive to learning technology. So even the direction-wise, right? You can see this. If you increase uncertainty, you either increase information acquisition incentive or lower information acquisition incentive. This all depends on the exact form of this benefit function and the cost function. And we don't have a good understanding of how these functions look like. We only have an intuitive argument. For example, the cost function there, I think this is most relevant if you think about the entropy. Think about probably some data is very, very easy for you to get, but you have to digest that. So the data itself is easier to access, but it's more difficult to understand what's going on. So that might be more relevant to cost. If you think about the benefit, like the channel emphasized by Savi and Adrian, it's maybe, so the data itself is easier to understand, but you have to spend some money for people to get data. You have to hire people, hire analysts, you upgrade your software, that kind of things, you get more data. It's kind of, we only have X and some argument to what context are more relevant to benefit channel, which context is more relevant to cost channel, but we really don't know so in reality what they look like. I think the literature is lacking those kind of evidence, so either empirical or experimentally to show how the functional forms look like. And, I think probably this can be a potential area for us to make a contribution. But now come back to the paper. So how can we improve the paper? I think as a theory paper, maybe you don't have to stick to one direction. You can think about all the possibilities. You just give a guidance to the empirical people. So in some scenario, you have this result. In some other scenarios, you have other results. So what I try to suggest probably is similar to what Mayat and Wallace do in their study paper. So they are also aware of this problem of this information acquisition technology. The results are very sensitive. So they kind of study the results. So their paper is thinking about the beauty context with the information acquisition, and they explore multiple possibilities and to give different directions. In the current paper, basically, it's the key is if you increase the variance of X, what will happen to tau epsilon? So you can have multiple directions depending on the context. So that's kind of my suggestion for how to improve the paper. So this is the first result. How about my time, Lauren? I have 10 minutes?
You can speak for another 3-4 minutes. Yeah.
Only 3 and 4 minutes. Time flies. Okay, I have other comments. The first one.
So there's a lot to say.
Thank you. The first one is about price informativeness. The paper takes a very standard definition of price informativeness in the literature, in the theoretical literature. Basically, if you think about the price, it's equivalent to the signal of fundamental value plus this endogenous noise. Z is the exogenous noise treating, D over B is the endogenous ratio. And price informativeness is the variance or this van over variance of this noise. That's the definition in the literature, price informativeness. But I think that interpretation is okay, or that's a measure in the literature when X is exogenous, because you don't think about in the literature, you don't think about the endogenous variance of cash flow. But the current paper, because the variance of X itself is endogenous, so that will make the result not unit free. So in other words, if you think about the signal quality, so normally in statistics, we think about the signal to noise ratio, or you think about the correlation coefficient between the cash flow and the price. So that will give you a unit free measure. So what I suggest is basically you try to normalize that using the endogenous cash flow variance, this variance X. So that will give you a unit free measure, which is between 0 and 1. That will be equivalent to this correlation coefficient. So under the current learning technology, I think in adding this element will not change the result. Actually, that will strengthen the result. But if you enter alternative learning technology, so the direction you have 2 competing forces. So we don't know which one will give you the right direction. But in the end, since you want to talk about, you speak to the empirical literature, so we have to connect to the empirical measures to think about how the measure in the theory kind of better match the empirical measures in the literature. And so unfortunately, the empirical literature is kind of very messy, because if you think about the price informativeness, you have to think about what's fundamental, what's information. Both terms are very slippery. We don't know what fundamental is, and the information are unobservable. As a result, people rely on a lot of different things to think about the price informativeness measures. I gave at least 8 measures, probably more than that. You have R squared, P, return, autocorrelation, all these kind of things. I think that probably you might want to think about some empirical paper you want to target and connect your theory measure better or closer to the empirical measures. So this is the first one. The second one is about the setting. So actually, this one is also one of my major comments. this either you can think about this one as an interpretation of the result. So in the paper, so you have n assets, which is a finite number, and you also have a continuum of investors. So then in this setting, how to interpret the assets? So to me, it's more like those assets, the variance are all aggregate because you have a different kind of base. You have a finite number of assets, you have a continuum of investors. So these are more like industry-wide aggregate risk. This is not really individual stocks. So my major concern about diversification. If you really want to capture diversification, multiple assets, you have to think about the finite number of investors and also finite number of assets and let them grow at the same speed. So the general idea of capturing diversification is in equilibrium, one investor will capture 1 over n assets. So that's very important because this is otherwise it makes the interpretation a little bit murky, difficult. In the accounting literature, people debate about this result. So initially, David and Maureen, they have a paper in JAF. They basically use the current setting. You have multiple assets, continuum of investors. They show information is priced. And then later on, accounting people, they develop models along this direction. You have a finite economy, and you let n number of assets go to infinity. They basically show the kind of information will not matter in that setting. Only systematic information matters. So that I think I also again, Savi and Andrew have thought about that. They have footnote 14 and make some intuitive argument. But I think this is a major kind of comment. Another comment is about the objective function of the paper. So the current model assumes the firm try to maximize the expected price. I think this can be justified, rationalized. Think about a risk neutral entrepreneur who initially owns the entire firm and then sell the entire firm. So I think that's justifiable. I'm interested in kind of if the initial shareholder risk averse, maybe they want to keep some share and sell some share. So how will the result change? Savi and Andrew mentioned that they try to endorse the ownership. Actually, in section 5, they have made some progress on this. They think about the benchmarking, and then they partially endorse the passive investing. But in that setting, the benchmark itself, gamma, is exogenous. So what I want to know is a true index trader will follow the market. The market itself is endogenous. So this will create an extra layer of fixed point problem. But this might be too much. This is more kind of complicated. Overall, I buy the mechanism, buy the result. And also some other results, like think about the passive investment might come from noise traders. So given the time constraint, I'm going to skip that. Overall, I think it's a great paper. The result is very, very surprising and a lot of rich results. So my major concern, major suggestion is to probably think about the robustness of the results, maybe make them kind of the interpretation better, so the more comprehensive. Also about the finance economy, that might be another suggestion to improve on the paper. Overall, it is a great paper, very, very fundamental, very relevant. Thank you very much.
Thank you very much, Liyan, for a rich and thoughtful discussion. Savitar, would you like to answer? Would you like a reply?
Yeah, well, first, Liyan, thank you so much. This was a really, really great, really thoughtful discussion. It's funny, the first comment is one that I think about a lot, actually. I guess the cheap answer to that is just to say, well, it's what Verrecchia does and what Vives does and what all these guys do. So we're just trying to stay within that paradigm. But you're absolutely right that like the assumption that we're taking is that you control the quality of the signal, and that you could also say I control quality of signal to noise ratio, or even other things, right? It doesn't have to be just those two. There are some theoretical papers now. I know Philip Strock has a paper with some co-authors that's coming out soon with this, like an axiomatic justification where they try to derive the optimal cost function, and it tends towards signal to noise. So what would be interesting to analyze? I mean, we can definitely do what you suggest, which is just generalizing kappa and then saying this is what happens for different functional forms. But it would, I think, also be interesting to just understand which axioms are being violated when you pick one cost function over another, and just alert people to say, like, well, if you choose this particular paradigm, then this is what you're implicitly assuming about your agents. So I think that's I think that's a great comment. On the other stuff, I largely agree. I think the price informativeness measure, we can try the ones you suggest. I need to go back and look at the diversification comment. I don't think I got that 100%, but maybe we can discuss that afterwards. But by and large, I think all your comments are super well taken, and hopefully we can use all of them when we're revising. So thank you very much.
Thank you. So we have a few minutes for questions.
So maybe I can ask a question, Laurent?
Of course, of course.
So, Savi, how big are the effects, like empirically, quantitatively, like how big are the theoretical effects that you find?
Well, we don't calibrate our model, and we're not kind of directly testing it in that sense. We have some kind of correlations to show that in the paper we do some kind of, I call it light empirical work. It's definitely not an empirical paper, but the growth in the differences are pretty significant. I think we have it's like a 5 to 10% difference from the stocks that are held the least by passive, least held by passive funds versus most held. There's a 10% difference in price informativeness. So it's sizable. I mean, I wouldn't say it's probably not the biggest driver, but it seems to be a noticeable driver. And this is also consistent with the literature. If you look at other papers, they do find that, okay, active investors tend to be driving price informativeness the most, but some of it is coming from passive investors as well. And so I think it's kind of an open question as to where and why that's happening.
Because when I look at real companies, I'm not sure how many of them have this supply channel in mind when making investment decisions.
So that's fair enough. I'm not well up on that, but I guess one of the kind of motivating examples that came to my head was Michael Dell taking his company private because he said he wanted to do some R&D and didn't want to get punished in the stock market, right? And so that's the kind of thing that passive investors can now provide cover for, right? That they can be there and you don't automatically get dinged in your stock price if you take a few big swings. So I think I've talked to a few people who are better informed on this than I am, and there seems to be some evidence that R&D and investment goes up after passive investment. But I would not be able to speak to causality.
I mean, yeah, if I may ask a question, is it, what you describe? I mean, could there be other reasons why it makes sense to go private if you want to engage in R&D? Thinking maybe you have less disclosure requirements and so forth.
Oh, sure, but I think most of them would involve being punished. Like most of them would involve taking a hit in your stock price, taking a hit based on some decision that you take. Right. And I think our point here is just that if you have a large base of passive investors, then demand for your stock will be high, even if, you undertake a project, have to disclose that something went terribly wrong or whatever the reason is. Right. You're right. There are myriad reasons why you might want to go private. This is just one particular one that we're looking at.
Are there other questions?
So I want to speak a little bit about Rotman's question. Actually, I also thought about that question. I think that's plausible. Probably if you think about the model, those firms are very, very sophisticated. They anticipate in the future the cost of capital will decrease, and so they increase the investment. Probably in reality, they are not that sophisticated. And maybe as you have more passive investing, the cost of capital decreases, and that will naturally lead them to increase their investment. So I think that's very plausible. As long as the cost of capital decreases, so the channel, I think it should work. Just I think model-wise, they make the firm very, very sophisticated. Everything looks very beautiful. In reality, maybe I think that that's also plausible.
Yeah, Raman, let me just add one point. I think like there's some, again, it's anecdotal evidence that firms that go public try to go public at the point when they will enter an index as well. So there are at least firms that are aware that it's good to have a certain set of passive investors or passive owners, in the sense that there is an additional demand that you don't get if you go public just before you would qualify for an index. Again, there's no true empirical research on that, but there's some evidence in that regard that you read about that would fit that bill.
Thank you. Are there more questions or comments? No? Okay, so I'd like to, I think we can all thank Savitar and Liyan for a great seminar.
Yes, thanks a lot, Liyan.
Thank you. Thank you.
So the next CAFE seminar will be held on Tuesday, May 11th, and Vic Randvik from LBS will present. So I hope to see you all in about 1 month.